probably have introduced yourself already, but you're a lot more interesting than I am. So let's turn it over to you, and here's one of our favorite Gators, gentlemen and ladies.
Thank you, Wayne. I appreciate that. Thanks again so much for having me. I think the last time I did this was maybe 8 or 9 years ago, something along those lines. And have fond memories of that. My only regret is this one's not in person, but maybe in sometime in the future, we'll be able to do it again in person. So let's get started. The topic of today's presentation is, can everybody see the screen clearly on the screen share?
Yes.
Okay,
Yes.
great. It's real estate stability in a volatile market with demographic shifts. So let's see here. So some of the things that we're going to talk about today, I'm going to give you a little bit of background on me so you can understand where I'm coming from and what has evolved my thought process over the years. We'll talk about volatility today in the public markets as well as in the real estate markets. We'll talk about institutional investor allocations. A lot of the institutional investors have allocations that are driven by directives from their consultants that they hire. So they hire professional third-party groups to do research for them and tell them where to invest their money, what percentage should go in what type of investment and why. And there's been some shifts in that over the years, and they're important to understand, because everything that creates a long-term trend usually has some upside potential if you are smart about it, research it well, and try to follow these patterns into ultimately a profitable business model. We're going to talk about investor sentiment and the influence of social media, private versus public investments, long-term valuation versus short-term valuation, real estate value influencers, and then again, as I mentioned earlier, these trends equal the potential for a good thesis and strategy, ultimately, if executed well, can create performance, which can create great growth or job opportunities or business growth opportunities for anybody. So at a background level, I am a graduate, Florida native and a graduate of the University of Florida. I graduated in 1985. My degree is actually in computer science and engineering. Spent a lot of time at Weill Hall, as you can imagine, but it's through College of Business. As I mentioned, I'm a Floridian. I come from a real estate investing family. My father ran all the real estate investments for the Rockefeller family in Latin America. And this was in the mid 50s, like 1955 through 1965. He reported to Nelson Rockefeller and did all the site acquisition and development for them in Latin America through a company called IBEC. So the reason I bring that up is because I've been in and around real estate investing for a long time. When I was younger, a lot of times my father would give me these sound bites of the do's and don'ts of real estate investing, some of which resonated more than others. And now all of them resonate because he had a lot of practical real world experience that's applicable. So what we might touch on some of those during the conversation. In 1995, I started a business called Techware Consulting as a private technical consulting firm that did custom software development, network architecture, and database architecture and design. And in 2 short years, I had 155 employees, and I sold that company to a public company called CBR that traded on the New York Stock Exchange. And why that's important was because it gave that liquidity event, gave me the opportunity to become a principal real estate investor in a meaningful way. Also with that liquidity, I was one of the founding shareholders of a bank called Landmark Bank out of Fort Lauderdale that we started in 1999. There were 12 of us that started that bank. And we have recently, sold that bank. The reason I said whoa is because got a call here on my my phone. Interrupted the screen there. So anyhow, let me get back to that. Let's see here. Okay, there we are. So I have a banking background, and in 1996, I became a principal real estate investor. And I sat on the board of that bank for 11 or 12 years. And so about 2/3 of the way through my tenure on that board was when the credit crisis came along in 2007 and 8. As a board member of a bank, it was clear there was going to be serious distress in the markets with tremendous upside. So we created TerraCap Management, which is a multi-fund private equity closed-end, value-add commercial real estate investment advisory firm. We started that in 2008. So, we're going on our almost starting our 13th year in existence. And right now we manage just under $2 billion in fair market value. Our first fund that we started, we opened that fund with $5 million, and we're opening the current fund with the target is $400 million in the first 3 months. We've had a nice start to that fund, and we're already, I believe, around 70% of the way there on that capital raise. So that's a little bit about my background and what we do. And so on the investment side, we focus on multi-family investments, such as Class B workforce housing. We do flex industrial warehouse office parks. We also do low to mid-rise Class A and B office. And then we also do some hospitality, like select service hotels and that type of product. And so we're on our 5th fund right now. We manage about currently about 8.5 million square feet of real estate. And as I suggested, it has a fair market value and, just under $2 billion. So let's get into the presentation. So what's been happening here is there's been a lot of volatility, and a lot of the volatility that we see out and about has to do with information and the access to information, the speed of access to information. So this access to information can be good or bad, depending on what side of the investment or the trade you are. So too much information moving around and too much readily available, for lack of better terms, investor sentiment can have serious implications on public markets. So this is publicly traded equities, if you will, also publicly traded real estate, which is correlated to the public markets, versus private real estate, which is what we do, which has very minimal correlation to any public markets. So some of the major things that we've seen recently is there's been Brexit that's had a major impact. Obviously, the coronavirus. Very recently, we saw the short selling and buying of GameStop, the politics and the influence of politics, geopolitical as well as domestic. And even now, Twitter has feeds on Bloomberg's monitors where people can see who's tweeting about what. And a lot of this information doesn't necessarily have to be true, but if it's out there, it can create investor sentiment. And investor sentiment in a public, highly liquid environment can create significant volatility. So if we look at some of the volatility over the last, let's say, 4 or 5 years, you can see some of the dramatic swings that occurred in valuations of certain companies. Now, the reason I bring this up is because it's not necessarily fair. There's certain companies that stocks are being punished based on volatility and investor sentiment and major movement, a lot of which is driven by electronic trading and other high volume traders, where a company can fundamentally be very sound, can have great future financial projections and have a great history of meeting those projections on a quarter-to-quarter basis, but can get punished financially because it's a publicly traded stock, and it's going along the ride, if you will, with investor sentiment. So I wanted you to see this just to get you a feel for the type of volatility that's out there and what that means in the investment world. So some of the things that are happening, I'm just gonna go back here, is alternatives to typical traditional equities or stocks are coming of age and are getting more and more attention. And those alternatives are, for example, private equity businesses, venture capital businesses, private real estate, such as what we do at TerraCap. So we have private closed-end funds with certain terms where an investor commits capital for a certain period of time, like 8 to 10 years is kind of traditional and market standard. We have infrastructure funds, timberland funds. Now we see cryptocurrency and other types of alternative investments that are presenting themselves instead of some of the more traditional equities. Now, what's happened, if you look at the last basically 20 years, institutional investors such as public pension plans, even college endowments, corporations or other institutional investors, they have started to shift their allocations away from equities. You could see in the left column there, from 60% of their allocations used to be in equities, it's down to 40%. And the reason we believe that's happening is because of this volatility or this excess access to information and investor sentiment. What's happening is those same institutional investors are increasing their investments away from equities and into alternatives such as the ones that we just talked about. So that's a very important component, especially if you're managing real estate funds. And I know a lot of you obviously are interested in real estate. So what's one thing you would want to look at, for example, is what are the types of returns that are expected between different types of products out there. So if you see listed equities in orange, you could see clearly more volatility than the others. You could see fixed income has dropped dramatically, and it's even dropped even lower. This is through 2019, through June 2019. So it's a little bit of an older slide. It's much more down towards, you know, the 0 to 1 range right now. You can see real estate has held pretty steady compared to the others and has offered a higher consistent return, averaging about 8%. Now, clearly coronavirus will influence that. It'll influence it much more significantly in those core markets such as New York, Boston, Chicago, Los Angeles, San Francisco, and even Seattle, because there's been a lot of things that have occurred. People are trying to, if for lack of better terms, at least near term, they're vacating larger vertical, highly densely populated vertical environments, and they're moving more towards horizontal environments. They're also trying to get away from public transportation dependent environments and other things of that nature. So those are some things that need to be viewed as important influencers. So for us at TerraCap, we have never invested in those primary gateway markets. And it's for a reason, because we've always felt that over time, the people and businesses would want to seek affordability. They'd want to seek lower tax environments, more business-friendly environments, and safer environments. So we've only invested in the fastest growing secondary markets, so we've avoided those core markets. And now along comes COVID, which has actually been a very big benefit to us, and has actually started to boost our markets, and we're starting to see increased in-migration and corporate relocations to our markets. So when we look at valuations, for example, even with real estate, if we look at valuations of publicly traded REITs or real estate investment trusts, they are influenced and correlated with the public markets. Again, I apologize about those calls that come in. I don't know if you guys can hear that, but let's hope you don't. They are largely influenced by investor sentiment, public market momentum, and just general public information versus long-term fundamentals. If we look at real estate, especially private real estate, it's valued mostly on income approach, but also influencing that in valuations is comparable sales and replacement cost. So that's important to a lot of institutional investors. They don't want the exposure and the volatility. What they want to do is they're starting to look longer term is how can we have investments that are valued on fundamentals and the strength of the company or the asset that backs the investment, as opposed to volatility and investor sentiment. So that's why we feel there's a departure away from equities and a bigger increase in alternative investments. So again, major pattern, something that you should pay attention to. I don't think it's going to stop. I think it's just going to increase, because in an environment where people can say anything about a company and influence its stock, and then get a lot of momentum behind a rumor that could be positive or negative, that's something that the more conservative investors want to get away from. So here's an example of equity residential. Some of you may have heard of Sam Zell. I know Sam. I've actually been on TV with Sam. I've done some segments on CNBC, Bloomberg, Fox, and have been on with Sam. This is his company. It is the largest public multifamily REIT out there. It's called Equity Residential. Along came COVID, as you can see, and in March, his stock was impacted by, in 1 week, a negative 15.8% drop in value. Now, it's interesting because the strongest asset class, there's two asset classes that did really well during COVID. One is industrial, flex industrial warehouse, industrial last mile, and multifamily. So for a multifamily company that's this significant, to see that type of a negative impact on their valuation is inappropriate, shall we speak. We on the private side hold multifamily assets and did not see any of that volatility. Actually, we saw increases in net operating income and increases in occupancy through 2020 through all of our workforce multifamily holdings. So the opposite happened to privately held multifamily versus what happened here with Equity Financial. If we go to the next slide, part of the reason for that, if you're privately held and you're not correlated, again, our stuff is long-term, it's backed by leases, right? So you can see what's in the box there. These long-term leases should give investors comfort that the value has contract law behind it. Where in a public market, even though these leases have contract law, because they're publicly traded, they can be influenced much more dramatically. So in private real estate, we didn't see a negative downturn in our properties. It's always based on valuation and the demand in the private markets for the assets. So another thing that's been happening that's very important to follow is the cost of construction. So in the last 5 to 6 years, we've seen an increase of 30 to 35% in the cost of new construction in commercial as well as in residential. Now, why is that important? Because if you have a big gap between new construction lease rates or rental rates versus existing comparable product lease rates, what will happen is that will hold off future supply, and it will dampen the appetite of the lenders or the banks to lend speculatively to create new future supply or speculative development. So I'll give you a real world example. If we were to build brand new Class A office in Tampa or Atlanta or in Nashville, we would have to lease it because of the cost of new construction. We'd have to lease that today at $35 to $42 a square foot. We can buy comparable Class A office in those same markets that are in pristine condition, maybe 10 to 20 years old, but pristinely maintained. That leases at anywhere from $22 to $28 a square foot. So that's a very significant difference between new construction lease rates at $35 to $42 a square foot versus existing comparable product lease rates. So as long as that gap is that big, that's going to hold off new supply, because no lender wants to build a new building for for a developer and take the risk that it may stay vacant, because if it's vacant too long, they'll default on the loan and they won't be able to service the debt. So that's good. And that's part of what we believe is elongating this real estate cycle. With a lot of people already feel it's long in the tooth, and we feel that this is what's contributing to it. But that's actually a good thing. And of course, rates are very low, which is also very good for real estate and is also helping elongate this cycle. So just important factors. Here's an example of what I just talked about. That rental gap will hold off speculative multi-tenant supply in office and even in Class A apartments. So for example, in Atlanta, where we have a lot of holdings, I think at one time we just sold a bunch of it in the last literally 4 months. But in Atlanta, we had about 12 to 1,300 units, and any comparable product that was being built had to be Class A because of the cost of land and cost of construction. So that product needed to be leased out. Typical rental rates for those apartments were anywhere between $2,200 to $2,800, where Class B workforce or B plus was leasing at $1,100 to $1,400. So that's too big of a gap for somebody to jump if they're workforce housing or a workforce employment type of person. So that's another reason why we like workforce housing. But really important to understand the influence of the increased cost of new construction right now. So the other thing that's really important when we look at trends, and I really want to recommend this, a lot of the students that I talk to, they ask, about certain markets that sound fun and sexy, like New York and Boston or Los Angeles or San Francisco. These are the dynamics that you need to take into consideration as a real estate investor. And when you're a fiduciary of funds like we are, and we represent right now about 86 institutional investors, and we represent about 510,000 pensioners across the country. So we have to be very careful in where we invest and why. So this is where the data starts coming very important. So we look at migratory trends, and when we invest, we only invest in the markets that have these 4 very compelling and are on the top of the charts in these 4 areas: employment growth, population growth or in-migration, also corporate relocations, the leaders in corporate relocations, and then also the leaders in financial strength for the state GDP or that submarket's GDP. Those 4 components are very important, because if you have those demand drivers and limited supply that I just talked about, then it becomes an issue of buying the best remaining vacancy in the best location and best built buildings that you can, because the demand is coming. And then along came COVID, right? The demand was already there, but along came COVID, and it has accelerated these demand drivers into these markets that I'm going to talk about with you. So if you look at the chart on the right, domestic migration, that's an 8-year look. You could see the big winners in green. This is all pre-COVID, okay? This has been accelerated since COVID. You look at the blue, you can see the states that are losing population. So for example, if we look at New York loses on average 150,000 people per year to out-migration. That has now gone up to about 250,000 people during COVID. That's pretty significant out-migration. Prior to COVID, New York used to send 60 to 70,000 people a year to the state of Florida. We look at the table to the left, this is compounded annual growth rate in population. So the green markets are the markets that TerraCap invests in. So you can see they're all well above the US average population growth, which is pegged right now at about 1%. It's interesting, when we started TerraCap 12 years ago, it was 1.3 to 1.4% over about basically a 42-year period. Now we're almost at 50 years. The compounded population growth has dropped down to 1%. But you could see in the markets like New York and Illinois, where the population growth is low, that means the demand there is probably lower. And again, along came COVID. So people are leaving these markets, making there less and less demand. So it's hard for you to push lease rates or increase lease rates and ask for higher rental rates and lease rates, creating value for investors if you're in a flat to no growth market. So that's why you want to avoid those markets. When we look at domestic migration by state, you can see again some of the big winners. They're basically the Atlantic Southeast, Texas, the Southwest being Arizona, and then the Mountain West being Colorado or Denver. This next slide here shows primary markets and that we talked about that TerraCap is not in, and you can see the rise in vacancy. This is from CoStar. So a lot of you already know who CoStar is. They're a pretty reliable source. Data is, only as good as who's entering it and how current it is and what the subset of data is. But this is a pretty good example of what's happening in some of these markets. So if you could see, the market rents have started to drop significantly in New York, Chicago, Los Angeles, Seattle, and San Francisco. And you can see the vacancy rates are increasing. So again, a lot of this softening was already happening before COVID in these primary gateway markets that are too expensive and taxes keep rising. So that was already starting to happen for the last 2.5 years to 3 years. Now COVID came along and has just accelerated this. So again, the key is be where the in-migration is coming and stay away from the markets that have out-migration. This is interesting because this shows the pending deliveries. For example, in one city, we look at New York City, you could see that projects that were to be delivered, for example, in 2023 and 2024, the collective amount of square footage, which is significant in 2022 alone, was expected to deliver 7 million square feet of new product in a market that's already softening. So as you can imagine, what's going to happen in New York over the near term is going to be pretty challenging for those that own real estate in New York. It creates great buying opportunities, but then the question becomes, how long till the recovery? So in these markets that are challenged, these core markets, what usually is a catalyst that can reverse this type of a trend? So there's two sides to this, right? How long will the trend go? When you lose tax base because of out-migration and corporate exits, your only options are to increase taxes or decrease services or both, which further compounds the problem. So what brings people back to these markets? What type of catalyst would need to happen to bring people back? And if you look at that historically, the only thing that does that is extreme affordability. And it takes years for that price discovery to occur and for that to become a reality. So there's going to be some long-term damage in those markets, and just something to be aware of. So when we look at the secondary markets, the markets that TerraCap is in, you could see the exact opposite is happening. Okay, and this is a trend that started before 2020, and then in 2020 we're going to see increases in 2021 and 2022 as a result of the accelerated out-migration from those other primary gateway markets. So we look at, for example, Phoenix. Chris, who introduced himself on the phone, Chris Thompson, and also Albert Livingston, myself, and a couple others from our team, we just acquired some property in Phoenix. So we took down $103 million low to mid-rise office building right on the border of Phoenix, Scottsdale, right on Camelback. And for example, while we were there, the last 2 times we were there, we met with the economic development group, the head of economic development for Phoenix Scottsdale. And he said in the last 4 years alone, this is pre-COVID, 304,000 people moved from California to Phoenix Scottsdale, and more than 76 businesses did corporate relocations from California just to Phoenix Scottsdale. So that is again a major demand driver for that market, and you can see that is not going to stop near term. So of the 28 people that we met with just on my last trip there, and that's from leasing agents to debt origination brokers to property management companies, Chris, myself, and Albert, we met with 28 different people. Of those 28, 8 of them had just moved in the last 6 to 12 months from California to Phoenix Scottsdale. So that's pretty significant little subset in a real world scenario. So these are the markets that you want to be in, where the vacancy rate is going down and the rents are going up, because as a real estate investor, you can create value and then you can sell the increased net operating income to the next buyer for a profit for your investors. So we look at multifamily. This is important because this is like the beginning of where the people go, the businesses follow, or the people are going there because they think that's where the job opportunities will be. So you can see here again on multifamily, the vacancy rates are going up in New York and in Los Angeles and in San Francisco. San Francisco vacancy rates in multifamily are in that 14+%. The numbers on New York and Los Angeles, I believe, are higher than what CoStar is presenting here. I've read multiple articles where it's higher, as much as 14 to 16% in New York, but we'll have to get more verification on that. This is what we've seen recently, and then the opposite holds true in markets like Denver, Atlanta, and Phoenix. These are the markets that TerraCap invests in. I want you to take a moment to look at these markets. These are 7 of the top 8 or 9 markets in the country on the metrics that I spoke about: employment growth, in-migration or population growth, corporate relocations, and financial strength. But look at some of the statistics behind these markets. So these are the markets you want to be in, because that's where you can create value. You don't want to be in a market that has flat to no growth or has an exodus occurring near term. Now that may change over time. I'm not writing off by any means long-term, New York or San Francisco, but for right now, they're too expensive and the demand has dropped dramatically, and the prices will follow that down. So another thing that's important to follow from a statistical perspective is the largest generation in the workforce. Right now, that's the millennials. So the millennials, who are 24 to 39 years old, are now becoming decision makers. Some of them are already major decision makers, or they're the decision makers of the future. So knowing where they're going is important, because they're going to drive where the businesses are going to be. So what's interesting about them, they represent 72 million people right now. What's interesting is 10 years ago, up to 5 years ago, the millennials all wanted to live, work, and play in those major metropolitan markets, those major core markets that we talked about. So they all wanted to live in San Francisco, Los Angeles, Boston, New York, Chicago. In the last 5 years, they've been leaving those markets. And the reason for that is because, like any other individual or human being, they start having families. They think about affordability, cost of living, taxation, safety for their families. So when there's social unrest and rioting and things of that nature, they want to avoid those markets. Or when there is excessive homelessness issues, they don't want their families to be around that. So this is also fueling the out-migration from those markets, and it's influencing millennials. So millennials are leaving those markets and they're going to other markets. So where are they going? The chart to the left shows how many are leaving from some of these markets. This is just 2018. Now remember, this is pre-COVID. So these numbers are much greater right now in 2019 and 2020 than they were in 2018. But look where they're going. Again, they're going to those TerraCap markets, the markets that we invest in, that are driven by population growth, corporate relocations, and financial strength, as well as job creation. So this is 2018 through 2020. This is not, these were projections for 2020. It does not have the 2020 numbers with COVID. But again, being data driven, we only invest in the markets that are above the green lines. If you look at the national average in employment growth projections, you could see it's as much as 1/3 of the markets that we participate in. So if you're going to invest, you want to invest where you have basically 2 to 3 times the demand that you would see in some of these other markets. That gives your investors comfort that you're in the right place. So we only invest above that green line. We do not invest below that green line. It was interesting. I was giving a presentation to the city of Pontiac, Michigan, the pension plan, and they are a fund investor in Fund 4, and they were looking at one of our newer funds. And one of the trustees said to me, when are you going to invest in Denver? Or I'm sorry, when are you going to invest in Detroit? And And so Detroit, as you can see, is not on that list. So it's a sensitive question because obviously they would like the people that they invest in, the investment managers, to invest in real estate in their own markets and in their backyard. And we wouldn't invest in Detroit right now. So my answer was, the second that Detroit is above that green line, we'll be all over at Detroit. We'll be investing in Detroit. But until then, we're not going to invest in Detroit because we're data driven and we have to stick to the data and the metrics. So that fortunately satisfied them. But I think they would have loved to see us in that market. So when we look at cost of living, I mentioned families and businesses are seeking affordability. This is the cost of living index. New York is pegged at 100%. But if you look at Dallas, for example, you can live in Dallas, Texas, 34% cheaper than living in New York. You can live in Phoenix, Scottsdale, like 33% cheaper than living in New York. And if you lived in Phoenix, it's like 30% cheaper than living in San Francisco. So this is the type of stuff that drives the movement of people seeking affordability in business-friendly environments. The other thing that I mentioned earlier that's really important is the financial strength of an environment. Because if the economy, the local economy is growing in that market, businesses can grow and thrive, and it gives them more confidence to expand, take on more office space, or invest in hiring more employees, take bigger risks, if you will, in their growth model. So you can see on the top there, the blue states are the blue bars, if you will, are the states that are growing their domestic adjusted gross income the most. That was 2018. And the bottom graph there, you could see in the red, those that have the worst net gain in domestic adjusted gross income are losing income. And remember, this is pre-COVID. So if you look at 2020 and 2021, maybe even into 2022, for example, New York and California and Illinois are going to see much more significant losses in billions of dollars than what you're seeing right here. And you'll see a lot of that going into those states on the north side as a result of the corporate relocations and in-migration. Part of that, as I mentioned earlier, the table on the bottom left shows zero tax states or flat tax states. Again, that's very valuable for businesses and people. This is a recent, very recent multifamily absorption by city. This is through the entire year of 2020. This is provided also by CoStar and some other sources that we validated it. But you could see the green markets there. Those are tear cap markets that we're in. They're all seeing net positive absorption. The red markets that are not seeing much absorption or are seeing significant negative absorption. Tear cap is not in any of those markets, but those are the markets that are losing people. And one of the frontline indicators of that is always multifamily. So especially, workforce type multifamily. This is something that's important and it helps elongate this real estate cycle. So we talked about one of the factors, and that was the cost of new construction is holding off speculative development. So if you look here, you can see for basically going on 10 years, we're much lighter on development in certain markets. This isn't a full look at the whole country. This is some select markets. We don't currently invest in Miami, but we do invest in those other markets. And so you can see that the demand has been a lot, the new supply has been a lot lighter than it's been in the previous run-up that created that bubble from the credit crisis. This is an opportunity that we just captured in Phoenix. And I think this is give you a great example of demand. So we just closed on this in 2 weeks ago, basically. It's a $103 million acquisition. So what we look for is to try to get a significant discount against replacement cost, creating what we call a capital appreciation component to our total return or the potential for capital appreciation component. So this is 333,000 rentable square feet on Camelback, a very, very good location. It's bookmarked by the fashion Biltmore Fashion Mall on one side and another major high-end shopping area on the other side. One of the things that's important is you look at our purchase price, which was significantly below the replacement cost of $459 a square foot. Another thing that's key to look at is when we got this under contract, the average rental rate was $30.41 a square foot. The newest leases that we're signing are now at $37.50 a square foot in a period of 2 weeks. Well, we got under contract about 60 days ago, maybe 75 days ago, or prior to closing on it. So in a period of basically 3 months, we've been able to increase the lease rates by 23%. Now, the competitive set, the buildings around it, you can't really see them. They start on the left side, all nice high-end Class A office like this. They're more high-rise than this. This is more low to mid-rise, which we think is more appropriate in the post or during COVID period. But there, the comp sets are at $38 to $42 a square foot. So that's another thing we look for, is try to buy things that are behind market rents, so that day one, when we do renewals or when we do new leases, we're able to sign them at a bump in net operating income, again, creating some early value for the investors, and then move with the market demand. And in these high demand markets, where you can usually increase lease rates anywhere from 3 to 6% for renewals, for new leases, where the lease may have built into it a typical 2 to 3% annual bumps, but when they're renewing and have to do a new lease, they have to go at market rates. And so if you're in these demand markets, you're able to push lease rates. So let's see here. So everything, the rubber meets the road here, of course. I'm going to move this here. The rubber meets the road on return. So, a lot of people, this is a case study, if you will, of a very, one of our funds. This fund, as you can see on the bottom, was closed to new investors in July 2019. So a little more than a year and a half ago. So I wanted to show you guys a very current case study. It's one thing to talk about case studies, that happened 3-5 years ago, but a lot of people are concerned about what's going on right now, okay, and exits or sales that are happening right now, and what kind of returns are possible right now. So one thing I would like to mention, and we do our portfolio construction at TerraCap, if we look at what happened during COVID, we had zero exposure to retail. So we did no retail. As I mentioned earlier, we do multifamily, flex industrial warehouse. We do Class A and B, low to mid-rise office, and we do very limited hospitality. So we had zero retail exposure. We had zero student housing exposure, and we had zero senior living or extended stay exposure. So that was very good, because our collections across all of our funds during 2020 ranged between, against normal rents or income receivables, if you will, were between 93 and 100%, depending on the fund. Now all of them are anywhere between 97 and 100%. So our lowest months were 93 to 96%, depending on the fund, but never below that. So that shows resilience in portfolio construction, and careful. We were big believers that e-commerce was going to be very real and very significant. So we avoided retail altogether, because it tended to be somewhat of a fluid thing. And now, we're very fortunate, and a lot of that's luck too, that we didn't go down that path, because that's a very vulnerable spot. So when we look at these here, the top, so this fund, for example, has had 7 distributions in the last year and a half. It was a $311 million fund. The target was $300 million in capital raised, equity raised. We oversubscribed it slightly to $311 million. But in the last year and a half, almost 2 years, we've already done 7 distributions, returned $73 million of the 311 million in invested capital, or 24%. And if you look here to the top right, I don't know if you can see the top right two columns, at the property level, the returns of net realized IRRs have averaged 19.8%, and the average equity multiple is almost 1.6%. The green bar here is representative of 2 more apartments that we're selling. So the multifamily, you can see we've been exiting multifamily because it's in high demand right now. We're exiting it at cap rates anywhere between 4.5% to 4.75%, which is fantastic for workforce housing. These 2 are getting ready to close next week. Just to give you an example here, we used $25 million in equity. We used $50 million in debt. Total purchase price for the 2 was right at $75 million. We're selling them for a combined $104 million. And the returns will be right here somewhere, if you average between the 2, around 21% or so net IRR, and about a 1.88 net equity multiple. So that's very real, very current. You could see these exits all happened in 2020. These exits happened, just in this last year, and one was in 2019. And then these multifamilies here in green will be exiting next week. So I believe I'm going to go through a summary right now at a high level of just some of the things that we talked about, and then we can open it up, Tim and Dr. Archer, for questions. So one of the things about private real estate is it has a very low correlation to the public markets. So we're not influenced by the fluctuation or the investor sentiment that goes on and creates those dramatic swings in values, which is a good thing. As I said, as you can see right there, job growth, population growth, corporate relocations, all those things are demand drivers for select markets. Obviously, the markets that don't see that don't have the same upside potential near term or midterm. The cost of new construction is a major factor and is holding off speculative development and elongating this real estate cycle. I'm not sure what the solution for that is, because there's really not a way to make the cost of construction go back down. So what's going to happen, I think, is the demand for existing product will continue to increase, and the lease rates for existing product will go up at an accelerated rate, much faster than typical, as demand continues to grow and supply is not there. And that will then start justifying the resurgence of new development when the lease rates, for example, for existing Class A office go from 23 to 28 up to 35 to $42 a square foot. In the meantime, those that hold those types of assets in these demand markets will be the beneficiaries. The same with the multifamily housing or apartments that I mentioned. The overpriced primary gateway markets, they're stalled. They have pending new supply that was going to get started, but it's now stalled, or will be delivered depending on where they are in the development cycle and where they are with regards to the process and construction, which could be a very, very dangerous time to deliver a building. Social issues, safety, pandemic, vertical living versus horizontal living, public transportation or the avoidance thereof for people, cost of living, taxation, and business-friendly environments are really the things that are driving demand in certain markets. So those are the highlights of the presentation. And with that, I'll open it up for questions.
Sir, you mentioned primary and secondary markets. Does TerraCap have any interest in tertiary markets? And if so, which ones?
So that's a great question. So when you're a investor and you start out, right, the tertiary markets tend to be the only ones you can afford, right? So the assets are smaller in value and size. But what happens is as you get larger and raise more capital, especially institutional capital, you look for a reliance of a more consistent, reliable exit. So when you need to sell, you want to make sure you have enough buyers. in tertiary markets or smaller markets, when things get soft, it's hard to exit assets, even if it's the best asset. And the reason is a lot of the local investors may not, may be hurt, not be able to take those assets on. But institutional investors tend to stay away from those markets. So we've transitioned. We started in tertiary. So we used to invest in Naples and Fort Myers and Sarasota, markets like that. But now we don't invest in those markets and we don't invest in smaller deals. When we look at our performance, the properties that did not perform so well were in the tertiary markets. The return profiles were not as high, especially if things were soft or if we were mid-cycle.
Thank you.
I'm not saying that that's not a good investment. I'm just saying for consistent, reliable capital chasing deals, you want to be more in the larger secondary markets right now. And again, like I would not be buying currently in the primary gateway markets either, right? So I'd only want to be in those demand markets where we're seeing the in-migration, the corporate relocations happening.
Well, if no one else has a question, I might pose one or two, maybe push back a little bit. You may anticipate a little bit of what I'm thinking, but I guess I have two things. And one is that it is true that the REIT market is more volatile than the private market. And I would argue, as many others do, that part of that's because returns and volatility is not well measured in the private market, right? Just because you can't see it, just because you don't have the transactions that are happening quickly enough to observe price declines, that doesn't mean they're not occurring, right? It's just that market's less liquid. And I think, some folks know I'm kind of a little bit of a REIT guy and kind of find myself defending REITs. It is true that in the short run, they're certainly more volatile. And again, I think that's because the way we measure returns in the private market just doesn't pick up what's actually going on. But if you look at the research if you look really short term, much more volatile. But over the longer haul, and it depends upon the study you're looking at in a period of time, REITs do perform like the real estate that they own, right? I mean, in other words, real estate and private markets, those returns are much similar over longer horizons, right? And the one thing you didn't mention is that when you purchase a REIT, you get liquidity that you don't get in the private market, right? So I guess I'm not disagreeing. I'm just kind of pushing back a little bit on the advantages of the private market relative to the public market. So you might want to react to that. I've got another comment, but it can wait.
Yeah, no, I mean, it's definitely a fair comment, and it's everything is relative, right? So one thing is somebody more of a long-term view, right? And they don't want to be correlated, if you will, right? They don't want to see fluctuations in value, even if it is short-term, like equity residential. They don't want that exposure that's not tied to the performance of the asset itself. It just doesn't seem fair, right? Another good example would be when we're experiencing a lot of net operating income growth. I know multiple REIT managers that were experiencing the same level of NOI growth in some years, 8-10%, but they weren't getting the credit for it. Their stock was not moving along as it should have been based on their net NOI growth. So the assets were performing well, but they weren't getting the upside either that they should have been getting, which should have been outsized. So to your point, they've been consistent, but when they had outside performance, those public equities and the volatility or the sentiment that was going on in other things were keeping down what they should have been rewarded for.
Right. Yeah, I think that's true. If you look at the long-term correlation of equity REITs to different measures, to the S&P 500 or other broad-based measures of the stock market, that correlation is, Bill probably has the number off the top of his head, and I haven't looked in recent years, this last year, but it's typically about 60%, right? So if you look at short-term returns, REITs are highly correlated with the general stock market, so they are picking up that sentiment and those movements that are causing movements in REIT prices that don't have anything to do with the underlying real estate. That's certainly true, I think. But over the longer run, and some investors have a much longer horizon than a month or a quarter, those correlations go down, and REITs tend to move more like the underlying real estate.
Right.
And then I, if I may, so you talk about demographics, convincing data, no doubt about it, right? And I think that obviously TerraCap has done real well. But the thing I always wonder about is that demographics are about the easiest thing to predict, other than sort of migration or population growth that comes from immigration or things that are a little more harder, more difficult to predict. My question is that how do you make money making bets on demographic information that's widely distributed, widely understood? And I would argue that your success in recent years has not been driven so much by the fact that you've been in some high growth markets, so that's a part. I would argue that what you really do well is that you buy properties at the right price, and you could probably do that in any market, right? In other words, you say you won't go to Detroit, but at some price you'd go to Detroit, right? If the price were low enough, the cap rate high enough, right? So what I'm getting at is, I'd like you to react to a little bit, is that you focused on the demographics, and I agree that gives you some ideas to where rents are going to go. But you also have to combine that with thinking about the pricing, right? And if people are pricing those future demographic advantages in some of these markets, you can still pay too much in Phoenix, right? If everybody understands Phoenix is growing like crazy, cap rates go down, prices go up. So I think it's a combination, I would argue, of picking markets that are going to grow quickly, but then also what you guys are really good at are buying at sort of low prices in those markets, and that's driving the returns as well. Anyway, sorry, I didn't mean for that to be a dissertation, but
No, Dr. Lane, and it's very accurate. Obviously, I have a limited amount of time, to talk about our thesis and strategy, but you nailed it on the head. So a key component that he's referring to here, everybody, is sellers under pressure. There's some type of pressure for them to sell, so you can buy it at what we call deep value, or some type of value buying. So what are some common things that we look for? So we would look for example, other competitive funds that are sunsetting, right? So it's a fixed closed-end fund with an 8-year life, for example. And let's give some great examples. So there were some funds that started in 2007 and 2008, or that they were doing a lot of buying in 2007 and 2008, right? Along came the credit crisis, but they'd already bought the assets. I'll give you a real world example. We bought in Sarasota 4 buildings, and it would be considered a tertiary market, to the gentleman's comment earlier about tertiary markets. So we bought 4 Class A office buildings, probably the best office buildings in suburban Sarasota, not downtown Sarasota, but suburban Sarasota. And the previous owner was TA Realty, which is a big player out of Boston. And TA Realty, I don't know, they manage probably about 24 billion. So, they're about 10 times our size. They paid $55 million for these 4 buildings, right? We bought the 4 buildings for $37 million, to Dr. Lang's point. The reason we were able to do that was because they were forced sellers, because they were sunsetting the fund, and they bought it at the peak of the market. And they didn't know the market as well as we did, because they're out of Boston and we're local here in Florida. So we saw the upside. We knew the demand drivers. We knew there was limited competing product. So we bought at basically 65% of their basis. That's a very good starting point, right? To your point.
Yep.
So we then sold after a 3-year hold. We increased occupancy, we pushed lease rates, and we sold at $45 million. Okay. So we didn't sell back at the 55 million. Remember, we bought at 38, but we enjoyed net operating income during ownership, right? And then $8 million in profit in addition to that. So it was probably like $12 million in profit. Remember, we bought for 45, so 12 million against a $15 million equity check. So that was a situation where there was a seller that had to sell, great asset, and we bought a discount because we had ready capital at that moment, and we had been actually trying to buy it off market for them for over a year. I think they're just tired of hearing from us. So we were very, very persistent. We knew they were expiring that fund, and we were just like, hey, we're over here, ready to buy whenever you are. So that's one example. The other thing we look for is dysfunctional ownership structure. So you've heard the term, and I'm sure you've taught this, TICs, tenants in common. So that's where multiple investors come together, and some of our portfolios that we bought of like flex industrial office parks or single story office parks and in and around airports or some of these demand environments, we bought them from TIC structures. So there were as many as 30 to 35 tenants in common or owners, right? And as you can imagine, we have 35, people, right, or investors in anything. It's just a matter of time till some of them either fight, argue, or some that are better capitalized than others can keep writing checks for tenant improvements or brokerage commissions or deferred maintenance, where another percentage of those 30 people say, I thought this was a great investment, but I only thought I was going to be in it for 2 or 3 years, and I'm tired of writing checks. So there becomes infighting, and those that can write the checks are tired of writing the checks for those that stopped writing the checks, and eventually they want to sell it. So we look for those as well. So that's sellers under pressure, or we look for undercapitalized sellers. So let's say there's a building and they have two tenants that consume 60% of the property, and it's in a fantastic location, and they lose those 2 tenants. Now, because they're so over levered, maybe they can't service their debt. So now they're a forced seller, they're in trouble, right? And maybe the debt is maturing, and you get access to all this through Bloomberg and other data screens. We can see when these mortgages mature or these loans mature. So there we are when the loans mature. So we can then go to them and say, well, look, we'll buy it from you in 30 days, all cash, no issues, heavy deposits, non-refundable, and it's hard for them to say no to that. So back to your question. So those are the kind of things that you want to look for, and that gives you really access to that capital appreciation component. And then, of course, you have the yield. But the ideal scenario for investors is, how do you, when you get to returns that are, 15% or better, maybe 6 right now in today's world, maybe 6 to 8% of that is yield, right? The net operating income. And the rest of that at time of exit is the capital appreciation component, which is tied exactly to what Dr. Ling is talking about, value buying.
Yeah, those are some great examples, right, of how you're picking your markets to some extent based on rent growth, but you're also, buying very, very smartly in those markets.
Thank you.
Yeah, Steve, you mentioned your strategy in terms of acquiring underperforming restaurants. Is your asset management group managed in-house, or do you source them as you find these properties?
So we don't do restaurants. It's nice to see you, Sammy. I know we spoke on the phone a while back. Good to see your face. We don't do restaurants. We don't do retail. So we've intentionally avoided those types of properties. I think there's upside there. I think there's going to be deep value acquisitions once COVID clears out, which is probably going to happen sooner than later. So it's just not an asset class we do. So, but the asset classes that we do, we use predominantly third-party property management companies, third-party leasing companies. So we work with the biggest national firms like CBRE, Lincoln Property, Cushman & Wakefield, JLL, Colliers. Those are the types of firms that we work with. And what we do that's a little different than what they're used to, they like to sign long-term agreements on property management. At TerraCap, because we take on what's called ERISA plan fiduciary liability at a general partnership level, we have to be able to make changes. If we have a bad management situation or an underperforming property manager or something along those lines, we have to be able to terminate them quickly. So we won't sign a 5-year lease with them, or a 5-year agreement with them, which is what they're used to. A lot of times they'll say, well, that's not market. We can't do that. And eventually, of course, they do it because they want the business. So they'll sign anything we put in front of them if they want the asset. So that's another thing, though. I think in general, I want to give everybody confidence about is just because something's been some way forever and somebody's telling you this is market, doesn't mean you have to go along with that. If you have the asset and they want it, they'll work with you. They'll find a way not to lose that deal with you. So.
All right, thank you.
So I think the data is very clear that the secondary markets are the markets that are winning right now and the places to invest. But I would argue that the primary markets are still very important, and not only very important, but the longer they hurt, the longer America hurts. So I guess my question is, what do you think it's going to take for cities like New York and San Francisco to recover? And then also I want to ask, at what point you think investors are going to see future value in New York? Maybe it's in 2026, 2027, that New York's going to be what it once was. And when do you think investors are going to come in and take advantage of the high vacancies and low rents to get some of these top buildings at a discount?
A great question. So, we did a lot of value buying coming out of the credit crisis, right? So our first and second fund were riddled with deep value acquisitions where there was a lot of distress. And that was, around the country. I don't think the distress was as bad with certain asset classes in certain cities as the COVID carnage is, if you will, or the pending COVID carnage. So what we learned is when you're a buyer, right, you don't want to be, first, some price discovery has to occur, right? And the way price discovery occurs is, first there's denial, right? So a seller who's going to lose money will usually never take the first offers, and that takes some time to happen. So it could be like you said, you pushed it out, you said 2025, 2026, that's probably at the end of the day, a probably very realistic number, because real estate always moves slower than we think, right? The price discovery on a down cycle takes longer than people think. It takes, and then the recovery, takes longer than people think. And it's not months, it could be years, right? So what happens is as a buyer, if I'm the first person that calls somebody, early on in a downturn and says, I want to buy your property, but it's really, I gave it fair underwriting, I had it appraised, and it's really and genuinely worth 30% less than what you paid, or 50% less than what you paid. Human nature is you are the bad guy, right? They don't want to sell to you. They don't even want to talk to you. It's insulting, right? So you don't want to be those first guys that call and do those low ball offers, even though they're fair market, but you don't want to be that person because it's never received well. So it takes them some time to get comfortable by seeing enough offers that are below their expectation till they finally say, the pressure is too much, I can't sell it, I've seen this, so on and so forth. So that takes some time. So I think, you're looking at a couple years of price discovery and disappointment from sellers, like anywhere from 6 months to 24 months till deals start really happening, and then there's some value creation. But what really is the catalyst that reverses these things is significant discounts. So that's what reverses it. That's what brings somebody back. So, but in the meantime, you got to remember, certain markets and certain neighborhoods are damaged significantly, and in the near to midterm, almost irreparable. Like they can't come back from that. And I'm talking about markets where there was significant vandalism and significant damage or departure of retail, where these places are boarded up and no one wants to go there, and it could be for years. So that doesn't just affect the retail in that area, it also affects the residential in that area and the businesses in that area. And that it tends to draw in what, for lack of better terms, an undesirable element of people that will hang out there or live out there, which again further elongates the recovery. So it's usually extreme affordability that drives somebody to say, all right, I know this particular block or 2 blocks or these buildings look bad, but we're willing to take the risk. And the reason we'll take that risk is because of extreme affordability. And then eventually, the one thing that's key about our whole thesis, if you look at all the past cycles, the one thing, there's only one constant across all the past real estate cycles and even economic cycles. You know what that is? Population growth. It's the only static line because you can't stop or influence too much population growth. And it's been on average between 1 to 1.3%, okay, over the last 50 to 60 years. It's the only straight line factor across everything that we researched. So that's part of the reason why we put so much money behind population and where it's going and why it's going. I mean, we track migration from county to county and try to understand why. Like I look at Miami versus Naples. I live in Naples, right? 2.5 times as many people move from Dade County, okay, to the West Coast than from the West Coast to the East Coast. So for every 25 people that come to Naples from Miami, only 10 go the other direction. So obviously there's more population there, but it doesn't take long, but especially when you have land constraints. So in the markets where you have constraints like New York or San Francisco, those are real land constraints. So people will come back, but it's going to take affordability to drive them back. But lower rental rates, lower condo rates for purchase, lower office rents, because they're taking a perceived risk of a certain period of time. So I actually think your timeline, it might be pretty accurate for when before the values would jump back. I would say probably you start seeing it maybe and again, this is, you know, all taking a dart and throwing it at a board, right? But maybe 2024, right? It's going to take a couple years for this stuff to shake out at least.
So do you think that some owners will just try to ride the storm and hold on for as long as they can and hopefully keep holding on until New York's back to where it should be rather than sell at a discount? Or do you think some owners are just going to look to sell and reinvest the proceeds into secondary markets to try to make back some of that money that they're losing?
Everything is tied to how well capitalized that owner is. A private owner's world is if their business has been shut down and they've lost a significant amount of income, if they have too much leverage or too much debt, you're going to see a lot of people collapsing. And then when it comes to businesses, like for example, we used to compete a lot, and it's interesting, we don't really compete with them that much right now, is those core open-ended funds. So the big player core open-ended funds, they are not competing with us at all as we raise capital in our current fund. And the reason is because they're dealing with redemptions and significant redemptions where institutional investors and other investors are asking for their money back, but they've put up the gates that they put up and are not able to fund those redemption requests. So like, for example, I gave a presentation today and one of the consultants was talking about a redemption request, and the best that fund manager can do right now is 10% of their request per quarter. So if they put in $100 million investment with them, you know, they're only able to get back 10 million per quarter. So think about how long it takes them to get all their money back, right? So they're not even able to do it. Why? Because they know, like for the core managers that we compete against or used to compete against, their returns last year were in the 5 to 7%. They've had downward pressure in the last, pre-COVID, and now COVID, they're flat to negative, right? They're probably going to be negative next year. We'll see, hopefully, if they can get a bounce back, because I have a lot of friends that run those funds and I don't want bad things to happen to them. But they've got real issues. So they're going to have to sell at discounts. They've got a lot of pressure from their existing investors. If you look at UBS Trumbull, okay, big open-ended fund. I'm talking about the August timeframe. They had a redemption queue at that time of $9 billion. Okay. And the wait looked to be about 8 years. Okay. So that's a well-capped, they're $24 billion group. One fund, open-ended fund, $24 billion fund. So that's significant trouble. And they're probably, my guess would be up over 10 or 12, maybe as much as 15%, where they're now giving discounts and management fees to try to keep their investors from asking to redeem their money back.
Thank you.
You're welcome.
Any other student questions?
I have a quick question. So speaking of your capital raising efforts with your current fund, how has that fundraising process looked over the past 12 months? Has it improved because of like what you're talking about with institutional investors maybe fleeing some of the more volatile, traditional investments and want to put more capital into real estate? Or has there been maybe a slowdown with the uncertainty?
So a lot of the other funds have experienced a slowdown of certainty. The open-ended funds are not able to raise capital at all because what I just talked about. They're in those core markets. They're experiencing redemptions and significant reduction in performance. Our fund, we've raised in this fund that we're raising, in 4 months, we've raised $350 million. And most of that has been from our existing investors who are repeat investors who like the performance and they like our lack of exposure in those core markets, and the consultants that govern their allocation mixes like the lack of exposure we have in those core markets. They like the secondary market, growth market story or thesis. The other thing is they, as I mentioned, they've been real pleased with the performance, and they're trying to get away from what they feel has been too much of a bubble being created in equities. So for us, we've actually raised more money faster than ever right now, but I think a lot of it is based on performance, and it's like say 70, 85%, between 70 and 85% from our existing investors.
I have a question about, so my background is as an energy consultant and like working with large public healthcare REITs. And I've obviously seen that big sell-off that's happened, obviously if you were in the nursing home business, it's not a good time to be in the nursing home business right now. Right. And a lot of value private equity groups end up buying the groups because they've seen the value and, the continual decline of price and whatnot, and they're trying to pivot out. But I'm speaking on that liquidity and that intrinsic pressure. You see a lot of that ESG or corporate governance stuff coming through the public markets and putting a lot of pressure on these healthcare or all REITs and all assets really. Are you guys seeing that pressure from the other pension funds and criteria and other criterias that you guys are working with? In terms of that kind of stuff?
Not as much as you would think. It's kind of the buzz, right? A lot of people are talking about it. We're seeing it in questionnaires and the RFPs, the requests for proposal from the consultants that represent a lot of these institutional investors. I mean, our investors are public pension plans, police, city, fire, like City of Boston, Chicago Police Department. Those are types of investors. We have corporate investors like Baptist Health System South, high net worth families, the founders of 5 Hour Energy, founders of Best Buy, Taft-Hartley unions, like the Teamsters, groups like that invest with us, and even University of Florida Foundation is vested with us. But so, a lot of the consultants are asking about that. And I think they're wanting to see, commitments towards that stuff. But I think they also realize that there's a practical expense that goes with that could be significant. And at the end of the day, and I hate to say this type of stuff because it's very important, but if it compromises the returns or squeezes the returns too much, all of a sudden it's not as significant of an issue. So we get it right now on paper. We're getting asked about it, but it doesn't seem if it's actionable yet. Like, in other words, we're not getting excluded or we're not losing opportunities as a result of it. Obviously, we've got LEED certified guys on our team. We try to, do as much of that as we can, but to completely retrofit existing buildings is cost prohibitive. And we don't do ground up construction at TerraCaps because we don't want to take on the construction risk, both the cost, lack of control, as well as the lack of control of the timeline or the third parties that build the buildings. If you know they don't report to you, you don't control them. So that's kind of the answer right there. It's out there. I think we're going to see more and more of it, but it has not influenced like a go or no go decision yet.
Great, thank you.
Welcome.
Well, I hope somebody else has the last question, because if not, I've got a 30-minute question for Steve.
What is it? When are we going out again?
What would you say? You've given us some really good clues already, but what would you say about how you go about selecting the properties you invest in?
Okay, so we talked about the markets, right?
Right.
That those fundamentals need to be there. Those metrics need to be there.
Right.
When it comes to the properties, we shift our allocation mixes again at a more of a high level, right? Based on where the best demand is and where the best opportunity is to push lease rates or rent. So right now, if we look at an asset class, that, and you guys hear this all the time, industrial, flex, industrial, warehouse, last mile, very good sector to be in if you can buy value. It's hard to. It's a lot of demand, so it's priced high. But if you're a sharpshooter, you can find opportunities like that. The other thing is multifamily workforce, as I mentioned, where you can do value add to certain units, and you can increase those units, ultimately getting higher lease rates for those premium units, and do a percentage of those and leave some meat on the bone for the next buyer. So we look, those are the two favored areas right now. And then low-rise office with more like single entry per tenant type office, like single story flex industrial office. We look for that. So those are some of the things there. The key is, the other thing we look for is properties that have been historically, and I mean near term, mismanaged. So one of the things I mentioned earlier, if I go back to this here, if you look at the current in-place rents, right? So when we got this under contract, the in-place rents for the existing rent roll was averaging $30.41 a square foot. The comp set was at $38 to $42 a square foot. So that's a 23, or that's a big difference. So our newest lease, we were able to go right away close to the comp sets, but not even at the comp sets, and bump the lease rate by 23%. So we look for that. The other thing we look for is like apartment complexes. Let's say they were being mismanaged by a local smaller property management company, and they were anywhere from, we did one in Bradenton actually that we talked about today, where when we bought the apartments, the asking rental rates were 17% behind the comp set. And it was 11% behind the comp set year one, and by year two, between our acquisition till we sold, we had increased the lease rates by 17%. So first year, 11%, and then another 6% the second year. And then we went from a 91% occupancy to a 98% occupancy. So we look for upside in occupancy where we can increase occupancy, and we look for something that's behind market rent so that any new leases or renewals are at the higher market rates, so that we can get a bump in NOI right away. Those are kind of the two key things that you want to look for. Mismanagement.
Where do you get your leads?
Where do we get our leads?
Mm-hmm.
So we used to have probably, coming out of the credit crisis, I would say 70% of our deals were off market. And a lot of those came to us from longstanding relationships in the brokerage industry. Now only probably 30% of our properties that we acquire are off market, because the market is, and the cycle is matured. So because properties are worth more, people, and there's less distress out there, it's hard to buy something off market. So what we do is we've actually established a reputation as being a very, very reliable buyer that closes on time without incident. And what's happened is, in the institutional market of real estate sales, or the higher end, higher quality real estate sales, certainty of transaction is hugely important to the sellers. So what happens is let's say even if it's an offering that goes out to market, and let's say you have let's say a seller in Atlanta has a listing, and they give it to CBRE to take to market. It's a good asset. They take it to market, and let's say there's 25 to 30 people ask for offering memorandums, qualified buyers, and then let's say there's 10 that make offers on the property. And of the 10, let's say 3 or 4 are in the strike zone of where the seller wants to be, and where that sorry, let's see here, where the seller wants to be, and where the seller's representative has set an expectation on the exit price. When you get into that strike zone, what happens then is they do what's called buyer interviews, where the sellers will have the top 3 or 4 buyers with the top bids and letters of intent get on the phone with the seller's representatives and the seller, and they'll interview the buyers. So they ask for things like, where is your equity coming from? Where do you stand on debt? Is your equity discretionary? Do you need a joint venture partner? Do you need any other committee approvals to move forward with this acquisition? All these types of things come out. What other types of acquisitions have you done in this market? Have you, what of the last transactions that you've done, how many have traded at the agreed upon price, or were there price adjustments? Were there any retrades? Things of that nature get discussed by the seller and the seller's representative and these buyers, us being one of those buyers. So one of the important things is to have a reputation as a reliable buyer that closes on time as scheduled without incident, because certainty of transaction and a lot of transactions is more valuable than even maximizing the price. We win deals sometimes where we're not the highest priced, but we're the most reliable buyer, because the last thing a seller wants to do is enter into a contract and then not have that buyer close, or have that buyer try to reprice or retrade them, and then the deal falls apart. Because taking a deal back out to market after you've consumed 90 days or so with a buyer that doesn't move forward, or you have problems with, can create a white elephant situation. It can cost that seller millions of dollars. So it's really important and very interesting, for lack of a better term. You heard like the term the horse whisperer, right? Or something like that, or the dog whisperer. Well, these sellers, brokers for these big brokerage firms, they know who are the reliable buyers, and they know who closes on time. It's a small industry. It's the 80-20 rule, as always, where 20% of the big brokers control 80% of the deal flow today, right? So if you're a reliable buyer and you've transacted with them, that seller will lean on the word of that broker as to how reliable. So say we've got 5 people, they'll say to that broker, which of the 5 are you comfortable with? Which of the 5 have you traded with? What was your experience? So what we do as a buyer is we'll give them a list of 100% of the transactions that we've done in the last 7 years. They can call anybody, the debt guy, the brokers, anybody on that list as a reference. And a lot of times they know people on that list, or we've already transacted with that broker multiple times as a buyer or a seller, and we're just viewed as a reliable buyer. So that's helped us win a disproportionate share of the deals that we've pursued, which is important, because you can raise a lot of capital, but if you can't get the deals you want to own in a market you want to be in, it's not really a good position to be in. So you need to leverage those relationships. I make a lot of phone calls to these brokers when we're in the hunt on a deal and say, look, we really want this transaction. Here's where we're at. The equity, 100% discretion. We control that equity. It's in-house. We don't have to raise the equity. We just need to call it. The debt's already set up. No more committees need to approve it. It's already approved by our investment committee. And the last component is we'll put up hard deposits that are significant at time of execution of the contract. And we do a lot of due diligence. We get early access to the property. So we do due diligence while we're negotiating the contract. So that helps us win. It's a long answer, but it's complicated because, it now is not as many off-market deals as before. So you got to just win more of the deals you pursue.
I don't know if it's a long answer, but it was a great one. Thank you. Do we have a last question from anybody?
Yes, I have two questions for Mr. Steve. First, that a person have $500,000 right now and wants to invest into real estate. So what kind of investment in real estate should that person do this period or even after the pandemic period? And the second question, I also want to ask that with certificates in real estate that you think that the student should get before graduating that will be helpful when they're working in the real estate industry?
Okay, thank you for that. I'm not sure if it's my connection, but I'm going to do one question at a time. Maybe someone going to help me, with a summary of that question, and that way I can answer it efficiently. I don't know if Tim or Dr. Archer had a clear understanding of that question, but I'm happy to answer them if you can summarize that for me, guys. Did you get that?
So yeah, the first question is, if a person has $500,000 right now and want to invest in real estate, so which should kind of investment in real estate that person should put the money in?
Well, right now, it depends a couple of things. It depends on whether they want to own a single asset or if they want to have diversification and de-risk the investment by owning a smaller part of a fund that owns a bunch of assets. So that's really depends on what's the appetite for that investor. The other thing is, and this Dr. Ling touched on this, there are great opportunities in every market. The one thing about real estate is that it is very local, right? So what could be happening in 3 square blocks in a city that are in demand, if there's demand in those 3 square blocks and everyone wants to be there, that's a good investment, even if what's going on 5 blocks away is not good. That's what makes real estate investing so exciting and interesting, is everything in every scenario is different. $500,000, can allow you to buy a small single investment, like a small rental property. If you were to ask me, and I had $500,000, I would probably buy a couple of workforce housing duplexes, and I would invest in a couple of duplexes in a demand environment, such as, like, say, Fort Myers or Cape Coral or Naples, something like that. That's one investment. The other thing you could do is you could go into a professionally managed fund, and they usually have minimums, investor minimums for high net worths that have, some other criteria, like they have to be, qualified investors and have to have a certain minimum net worth in order to participate in certain fund structures, like private funds like ours. But that would be another way to invest the money. That way you're not involved at all. So if you wanted to participate in the management, I would do a small asset, and I would, if it's and the other thing too is, are you looking for income? There's a lot of questions there. Do you want income from that property? Do you want to be able to control when to buy or when to sell it? If so, if you want 100% control of that, you'd want to own it on your own as an individual versus in a fund. If you do it in a fund, then you're locking it up and someone else is in control of the disposition or the sale of that.
Thank you for your advice. I'm sorry that my English have the typical accent to listen, so please try to hear me. Another question that I also want to ask, that I heard that working in real estate in the United States, some people have kind of certificates in real estate will become more competitive to get a job. So my question is, which certificate in real estate do you think that students should get before they graduate that may be helpful for them in the future career in real estate industry?
The first answer is you want to graduate from the #1 ranked master's program in real estate, which is the University of Florida Bergstrom Center for Real Estate Studies master's program, MSRE. That speaks volume. So that's one thing I would pursue. The other thing I would say is a very good understanding of finance. So those would be the two areas that you want to pursue. Masters from Bergstrom Center, and also a degree in finance or a very good understanding, maybe a minor in finance, and that type of stuff.
We didn't pay him to say that.
Yeah.
Thank you so much, Mr. Steve and Dr. H.
You're welcome, Nancy.
Wait, he's supposed to pay us to. He's supposed to pay us to say that. I think, Wayne.
Right. Well, we're pushing the limits of our time here, I think, and our audience has been tremendously loyal. I see they're all still here, and for good reason. I consider myself a great forecaster. I said before this that we'd have a very interesting and rewarding guest today, and I was right. So, Steve, it's good to see you back again, and thank you. And we'll look forward to getting you on site in the future.
Thank you. I appreciate it. Just one question. How many total attendees, Wayne, do we have?
I'm sorry, how many what?
How many
68.
68, yeah.
Oh, that's a big crowd. Well, thank you everybody for your patience and watching the whole presentation and hanging in there. Go Gators. And hopefully we'll get to meet some of you in person. But I think you're all headed towards very promising careers. You've got the best team there supporting you at the Bergstrom Center. And it's an enjoyable career. I've done other things in other businesses, and my favorite is what we do right now. So I'm very excited for all of you.
Thank you, Steve. Good to see you.
Good seeing you.
Great job. Good stuff.
Thank you for your time.
Take care. Bye.
Thank you.